Is ratio spread hedging right for you? Have you ever wondered if a ratio spread hedge could be the right strategy for your options trading? Let's break down what this strategy entails and see if it aligns with your trading goals and risk tolerance. A ratio spread hedge is an options strategy that combines long and short options on the same underlying asset, but with different strike prices and typically in unequal quantities. This setup allows traders to profit from specific price movements while managing risk exposure. To start, the basic concept of a ratio spread involves buying a certain number of options at one strike price and selling more options at a different strike price. For instance, you might buy one call option and sell two call options at a higher strike price. This creates a position that can benefit from moderate moves in the underlying asset. Depending on the strike prices and premiums, this strategy can result in a net credit or debit. Next, let's discuss the risk and reward characteristics. With a ratio spread, you often have limited profit potential if the underlying price moves to a specific range near the short strike at expiration. However, there is undefined or potentially significant risk if the underlying price moves sharply beyond the short strike, especially in the direction of the short options. The maximum profit usually occurs when the underlying price is close to the short strike price at expiration, causing the short options to expire worthless while the long options retain value. Now, consider your directional bias and market outlook. Ratio spreads can be tailored to express a mild directional bias without fully committing to a strong trend. For example, a call ratio spread is suitable when you expect a moderate rise in the stock price, while a put ratio spread works for a moderate decline. This flexibility makes it a good option if you have a directional view but want to reduce the cost of establishing that position. When it comes to hedging and risk management, ratio spreads can serve as a hedging tool. They reduce the net cost of a bullish or bearish position while keeping some upside potential. However, because this strategy includes short options, it requires careful monitoring and possibly active management to avoid large losses if the underlying moves sharply against you. Delta hedging techniques may also be used alongside ratio spreads to manage directional risk dynamically. It's important to note that this strategy is more complex than simple long or short options positions. Understanding option Greeks, such as delta and gamma, as well as implied volatility and expiration dynamics, is essential. This strategy suits traders who are comfortable managing multi-leg options positions and can monitor their trades closely. If you are a beginner or not willing to accept the risk of significant losses, ratio spread hedging may not be the best fit for you. Lastly, let's look at practical applications. Ratio spreads can generate income by collecting premium from short options while maintaining some protection from long options. They can also be part of a broader portfolio strategy to hedge existing stock positions or speculate on moderate price moves with limited upfront costs. Traders often use ratio spreads when they expect the underlying asset to stay within a certain price range or move moderately in one direction. So, is ratio spread hedging right for you? If you seek a cost-effective way to express a moderate directional view with some built-in risk management, and you have the experience to manage the risks of short option exposure, this strategy may be suitable. However, if you prefer simpler strategies or cannot dedicate time to managing the position, it might be best to consider other options.